You've heard the phrase 1,000 times, the stock market. And maybe, just maybe, something tightens in your chest when you do. Not because you don't understand it, but because you're not sure you were ever supposed to. Nobody sat you down at 25 and explained it. Nobody handed you a roadmap. And somewhere along the way, you started believing it was built for other people. Smarter people, luckier people, people who started earlier. So you kept your distance. And now, here you are. Older, wiser, a little tired. And something in the back of your mind keeps asking the same quiet question. Is it too late? It isn't. But before we talk about what to do, we need to talk about what this thing actually is. Because most people trade their whole lives reacting to something they never truly understood. Today, that changes. Let's start at the beginning. Not the textbook beginning. The real one. Imagine a woman named Clara. She's got a bakery, best cinnamon rolls in town. Business is good, but she wants to open 3 more locations. Problem is, she doesn't have the money. She could borrow from a bank, but banks charge interest, and she's not sure the margins will hold. So she has another idea. She goes to her neighbors, her regulars, the people who've been eating her cinnamon rolls every Sunday morning for 7 years. And she says, I want to expand. I believe in what I'm building. If you believe in it too, invest in it. Become a part of it. And when it grows, you grow with it. That's it. That, in its purest form, is what a stock is. A small piece of a business, a claim, a bet. Yes, but not a blind one. A bet made on something real, something that makes things, sells things, employs people, solves problems. The stock market is just the place where millions of those bets are made every single day. Now, it sounds simple when I put it that way. And in some ways, it is. The core idea hasn't changed in centuries. Long before Wall Street existed, merchants in Amsterdam were trading shares of the Dutch East India Company in the 1600s. People pooling resources, sharing risk, sharing reward. What has changed is the speed, the noise, the sheer volume of it. Today, billions of dollars move through the market every hour. Algorithms make decisions in fractions of a second. The ticker tape that used to scroll slowly across a board now flashes so fast, it's almost meaningless to watch. And that noise, that constant, relentless noise, is what makes people afraid. Here's what I want you to hold on to. The noise is not the market. The noise is just people reacting to the market. And most of those reactions are emotional. Fear, greed, panic, euphoria. The market itself, underneath all of that, is still just Clara's bakery, scaled up a few million times. When you buy a share of a company, you own something, a tiny fraction of their buildings, their equipment, their revenue, their future. You are, in the most literal sense, a part owner of that business. That changes how you look at it, doesn't it? Not a gamble on a number, not a spin of a wheel. Ownership. And ownership, real ownership, requires patience. It requires understanding. It requires you to stop reacting to the noise and start paying attention to what's actually underneath it. We're going to get there. But first, you need to understand how the machine moves and why it moves the way it does. Because once you see it clearly, it stops being something that happens to you. And it starts being something you can actually use. There's a question nobody asks out loud, but almost everyone thinks. Why does the stock market go up and down every single day? If a company is solid, if it's making money, serving customers, paying its employees, why does its value seem to change by the minute? The short answer is this. The price of a stock is never just about the company. It's about what people believe the company is worth. And belief, as you know, is a fragile thing. Let me give you an example. Say a company announces earnings, meaning they report how much money they made last quarter. The numbers are good, better than expected even. And yet, The next morning, the stock drops. How does that make sense? Because the market had already priced in those good numbers. Investors were expecting even better. And when reality didn't match the expectation, down it goes. This is one of the hardest things to internalize about the market. It doesn't trade on what is. It trades on what people expect, which means you're not just analyzing businesses. You're analyzing human psychology, collective emotion, mass behavior. That's what makes it complicated. And honestly, that's what makes it fascinating. There's a concept in economics called price discovery. It's the process by which the market, through millions of transactions every day, tries to figure out what something is actually worth. Every buy and every sell is a vote, a judgment, an opinion expressed in dollars. Sometimes those opinions are rational, sometimes they're not. In the short term, the market behaves like a crowd at an auction, emotional, reactive, easily swayed by headlines and rumors. Someone whispers that interest rates might rise. The crowd panics. Someone else announces a breakthrough product. The crowd floods in. But in the long term, the market behaves differently. Over decades, the prices of good companies tend to track something much simpler: their actual earnings, their actual growth, the real value they create in the world. Benjamin Graham, one of the most important investors who ever lived and the man who taught Warren Buffett, put it this way. He said the market is like a voting machine in the short run and a weighing machine in the long run. In the short run, popularity wins. In the long run, substance wins. That distinction matters enormously for you, especially now. Especially at this stage of life, when you've seen enough cycles to know that panics don't last forever, and neither do booms. You've lived through at least one crash, maybe two, maybe more. And if you're honest, the thing that hurt most wasn't watching the numbers fall. It was not knowing whether they'd come back. They did. They always have. Not for every company, not for every sector, but for the market as a whole. Over time, the trajectory has always been upward, not smoothly, not without pain, but upward. And that's not optimism, that's history. The question is never really, will the market recover? The question is always, will you still be in it when it does? That's the game beneath the game. And understanding it, truly understanding it, is what separates the people who build wealth from the people who chase it. Okay, so we've established what the market is. We've talked about why it moves. Now comes the part that most financial content skips over or buries in jargon until you stop caring. What do you actually buy? Because the stock market isn't one thing. It's more like an enormous store with thousands of different products on the shelves. And knowing which shelves to even look at, that's where most people get lost. Let's break it down simply. When most people say they're in the market, they usually mean one of two things. They own individual stocks, shares of specific companies, or they own funds, which are collections of many stocks bundled together. Both have a place, but they are very different animals. Owning individual stocks means you're making a direct bet on a single company: Apple, Microsoft, Johnson & Johnson. You believe in that specific business, its leadership, its products, its future. If you're right, the rewards can be significant. If you're wrong, or if something unexpected happens, you feel every bit of that too. It requires research, attention, emotional discipline, and honestly, a certain tolerance for uncertainty that not everyone has, or should have. Funds are different. When you buy a fund, you're not picking one company. You're buying a slice of many companies at once, sometimes dozens, sometimes hundreds, sometimes thousands. The most important type for most everyday investors, and the one that's quietly built more long-term wealth than almost anything else, is the index fund. An index fund doesn't try to beat the market. It is the market, or at least a piece of it. The S&P 500, for example, is an index of 500 of the largest companies in the United States. When you buy an S&P 500 index fund, You own a tiny fraction of all 500 of those companies at once. Apple and Amazon, Visa and Walmart, Berkshire Hathaway and ExxonMobil. You're not betting on one horse. You're betting on the entire race. And here's what makes that quietly powerful. Over the last century, through wars and recessions and market crashes and pandemics, the S&P 500 has returned an average of roughly 10% per year. Not every year. Some years it was up 30%. Some years it was down 40%. But averaged out, over time, 10%. That doesn't sound revolutionary until you run the numbers. If you invested $10,000 into an S&P 500 index fund at age 45 and never touched it, by age 65, at that historical average, you'd have roughly $67,000. Not because you were brilliant, not because you timed the market, not because you had inside information or a sophisticated strategy, simply because you stayed. Now, I'm not telling you what to do with your money. That's not what this is. Everyone's situation is different. Everyone's timeline is different. And past performance, as they say, is never a guarantee. But I am telling you this: the myth that the stock market is only for the wealthy, only for the young, only for the people who got in early. That myth has cost ordinary people more than any market crash ever has. Because the real loss isn't the money you lost in the market. It's the money you never put in because you were afraid. Fear is expensive. Paralysis is expensive. Waiting for the perfect moment, which never comes, by the way, is one of the most costly financial decisions a person can make. There's an old saying among investors: time in the market beats timing the market. It's almost annoyingly simple and almost universally ignored because our brains aren't built for it. We're wired to react to danger, to pull back when things feel uncertain, to wait for calm before we move. But the market rewards the people who move when it's uncomfortable. The people who bought during 2009, when everything felt like it was falling apart. They didn't do it because they were fearless. They did it because they understood something the panicking crowd didn't. The story wasn't over. It never is. There's something nobody warns you about when you start investing. Not the crashes, not the volatility, not the confusing terminology or the overwhelming number of choices. Something quieter than all of that. And far more dangerous. Yourself. I know that sounds harsh, maybe even a little unfair, but stay with me. There's a field called behavioral economics. It studies the gap between how people should make financial decisions, rationally, logically, calmly, and how they actually do. And what researchers have found over and over again is that human beings are spectacularly bad at managing money under pressure. Not because we're stupid, because we're human. We have biases baked into us from thousands of years of survival instinct. And those instincts, which kept our ancestors alive on the savannah, absolutely wreck us in the stock market. Let me walk you through a few. The first one is called loss aversion. Studies show that the pain of losing $1,000 feels roughly twice as intense as the pleasure of gaining $1,000. So when the market drops, our emotional response is disproportionately large. We feel the loss so acutely that we make decisions designed to stop the pain, not decisions designed to build wealth. We sell when we should hold. The second is recency bias. Our brains give enormous weight to whatever just happened. If the market has been going up for 2 years, we start to believe it will go up forever. We get confident. We take on more risk than we should. And then, when it falls, and it always, eventually falls, we're shocked. Conversely, after a crash, we assume the worst is permanent. We can't imagine recovery, even when history tells us, clearly and repeatedly, that recovery always comes. The third is herd behavior. We watch what other people do and we follow. Not because we've analyzed the situation, but because being alone in a decision feels terrifying. If everyone is buying, we buy. If everyone is selling, we sell. We let the crowd think for us. And the crowd, collectively, is not wise. The crowd is emotional. The crowd panics. The crowd chases highs and flees lows and does exactly the opposite of what builds wealth. Here's a number that illustrates this painfully. Over a 20-year period ending in 2020, the S&P 500 returned an average of about 6% per year. Solid, steady growth. But the average individual investor returned closer to 2.9%. Less than half. Same market. Different results. Because of behavior. The investors who underperformed weren't unintelligent. They weren't unlucky. They simply kept reacting. Buying high because it felt safe. Selling low because it felt necessary. Moving in and out, trying to outsmart the machine, and losing ground every time they moved. The investors who captured closer to the market's actual return, they did something that sounds almost too simple. They made a plan. And they didn't deviate from it. Not when the headlines screamed panic. Not when their neighbor told them to pull everything out. Not when their own gut was twisting and saying, "Get out now." They stayed. Now, staying doesn't mean ignoring reality. It doesn't mean blindly holding on to something that's fundamentally broken. There's a difference between discipline and denial. But for most people, most of the time, the problem isn't that they're holding the wrong things. The problem is that they keep moving. Think about it in terms of a garden. You plant something. You water it. You tend to it. And then, when the winter comes and everything looks dead, you dig it up. And you plant it somewhere else. And the cycle repeats. Nothing grows. Not because the soil was bad, not because the seed was wrong, but because you couldn't tolerate the winter. The stock market has winters. Every single year, there's a stretch where it drops, on average, about 14% at some point within the year. Every year. And most years, it finishes higher than where it started. The winter was always temporary. The people who built wealth weren't the ones who avoided the winters. They were the ones who stayed in the garden. There's a concept so powerful that Einstein allegedly called it the eighth wonder of the world. I don't know if he actually said that. But whoever did, they weren't wrong. Compound interest. You've probably heard the word. Maybe you've even nodded along when someone mentioned it. But I want to slow down here, because most people hear compound interest and think they understand it. And they don't. Not really. Not in the way that changes how you feel about money. So let me show you instead of telling you. Imagine two women. Same age, same income, same starting point. The first one, let's call her Margaret, starts investing at 35. She puts in $300 a month. Does it consistently, without drama, without trying to time anything. At 65, she stops. The second one, let's call her Diana, waits. She's busy. Life gets in the way. She tells herself she'll start when things settle down. She begins at 45. Same $300 a month. Same consistency. She also stops at 65. Both women invested for years. Both were disciplined. Both chose reasonable index funds with similar returns. But Margaret invested for 30 years. Diana for 20. That single decade of difference, Margaret ends up with roughly twice as much money as Diana. Not because she was smarter, not because she earned more or took bigger risks, simply because she started 10 years earlier and let time do what time does. This is compounding, and it is ruthless in both directions. When it works for you, it feels almost unfair. Money making money. Returns generating more returns. The longer it runs, the faster it builds. Not in a straight line, but exponentially. The last 10 years of a long investment often produce more growth than the first 20 combined. And when it works against you, in debt, in fees, in inflation eroding savings that aren't growing, it's equally relentless. Quietly, invisibly. Until one day you look up and realize how much ground you've lost without ever feeling a single moment of loss. This is why fees matter more than most people realize. A 1% annual fee doesn't sound like much. Over 30 years, on a $100,000 investment, that 1% costs you somewhere in the range of $80,000 in lost compounding. Not taken from your pocket directly, just quietly never created. This is why starting now matters more than starting perfectly. People spend enormous energy trying to find the right investment before they begin. The right fund, the right moment, the right allocation. And while they're researching, time keeps moving. And time, once gone, cannot be bought back at any price. I've talked to women who waited 10 years to start investing because they wanted to understand it better first. And I understand that impulse. Truly, I do. The desire to be ready before you leap is wise in most areas of life. But in investing, waiting to be ready is itself a financial decision, a costly one. You don't need to understand everything before you begin. You need to understand enough. And then you need to begin. There's a concept called the cost of waiting, and it's as real as any market loss. Every month you keep your savings in a low-interest account while inflation runs at 3 or 4%. You're losing purchasing power. Slowly, silently. The number in your account doesn't change. But what that number can actually buy, that shrinks. The market, for all its noise and volatility, has historically been one of the most effective tools ordinary people have ever had for outpacing inflation and building real wealth over time. Not the only tool, not a perfect tool, but a real one. And here's what I want you to sit with before we move on. You are not too late. I know that's what you've been thinking. Somewhere under all of this, that ship has sailed, that window has closed, that the people who got rich from the market started at 25, and you are not 25 anymore. But compound interest doesn't care about your past. It only cares about what you do from today forward. 10 years of disciplined, consistent investing, starting right now at whatever age you are, can change the trajectory of the rest of your life. Not into something dramatic, not into sudden wealth, into something better, steadier, more secure, with more choices and less fear. And that, more than any number, is what financial freedom actually feels like. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. Because what we talk about here isn't theory. It isn't abstract. It's the kind of thinking that quietly reshapes the way you see money and the choices you make with it. And if this conversation has felt like something you needed to hear, there are people in your life who need to hear it too. We'll get to that. But first, let's talk about the part everyone avoids. Actually starting. Here's what I've noticed. People spend months, sometimes years, consuming financial content, podcasts, articles, YouTube videos. They take notes. They feel informed. They feel almost ready. And then they don't do anything. Not because they're lazy, not because they don't care, but because the gap between understanding something and actually doing it is wider than it looks. And that gap is filled with one thing: doubt. What if I choose wrong? What if the timing is bad? What if I lose it all? So let me try to make this as concrete as possible. If you are starting from zero or starting over, here is a simple framework. Not the only framework, but a reasonable, proven starting point for someone who wants to build long-term wealth without becoming a full-time student of finance. Step 1. Get your foundation in order. Before you invest a single dollar in the market, make sure you have an emergency fund. 3 to 6 months of living expenses sitting in a high-yield savings account. Accessible, stable, untouched. This isn't exciting, but it's the thing that keeps you from having to sell investments at the worst possible time because life happened. Because life always happens. A medical bill, a job change, a car that decides to fall apart at the most inconvenient moment. Without that cushion, you're forced to liquidate investments when you can least afford to. You lock in losses. You derail years of compounding in a single, desperate moment. The emergency fund is not optional. It's the foundation everything else rests on. Step 2. Take full advantage of tax-advantaged accounts. If you have access to a 401k through your employer, especially one with a match, that match is the closest thing to free money that exists in personal finance. If your employer matches 50% of your contributions up to 6% of your salary, and you're not contributing at least 6%, you are leaving part of your compensation on the table every single month. After that, consider a Roth IRA or a traditional IRA, depending on your tax situation. These accounts let your investments grow either tax-free or tax-deferred, which means compounding works even harder for you because you're not bleeding a percentage to taxes every year along the way. Step 3. Choose simplicity over sophistication. This is where most people overcomplicate things. They research hundreds of funds. They try to build elaborate portfolios. They read conflicting advice until they're paralyzed. Here's a quieter truth. A simple 3-fund portfolio, a total U.S. market index fund, an international index fund, and a bond fund has outperformed the majority of actively managed funds over the last 30 years. Not because it's clever, because it's consistent, because it's low cost, because it doesn't require you to make decisions every time the market sneezes. The goal isn't to build the most sophisticated portfolio in the room. The goal is to build one you'll actually stick to. Step 4. Automate everything you can. Set up automatic contributions. Every month, on the same day, the same amount moves from your account into your investments. You don't have to think about it. You don't have to feel ready. You don't have to watch the market first. It just happens. And over time, those automatic, unremarkable contributions become something remarkable. Because the market rewards the people who show up consistently, not the people who show up brilliantly. You don't need to be brilliant. You just need to keep showing up. We started with a question you didn't say out loud. Is it too late? And we've spent this time together not answering it with a number or a formula, but with something more honest than that. With the way markets actually work. With the psychology nobody warns you about. With the quiet, almost boring truth that time and consistency have built more wealth for ordinary people than genius ever has. You don't need to become someone different to do this. You don't need to be fearless. You don't need to be an expert. You don't need to have started younger or made better decisions a decade ago. You need to understand what you're actually doing when you invest. And you need to begin. Clara's Bakery. Margaret's 30 years. The Garden in Winter. These aren't just stories. They're the same story, told different ways. About the gap between waiting to feel ready and simply deciding to begin. About the cost of staying on the sidelines while life and time keeps moving. The stock market is not a machine built for the wealthy. It is not a casino for people who like risk. It is, at its core, a mechanism for ordinary people to become part owners of the economy they already live in. To let the growth of businesses they believe in compound, quietly, over years, into something that gives them more choices. More choices is what freedom actually looks like, not a number in an account, not a date on a calendar when you get to stop working. The feeling of knowing that if something changes, you have options. That you are not one bad month away from a decision you can't undo. That you built something, slowly, without drama, and it held. If this conversation helped you see something differently, even one thing, I want to ask you to do something right now. Share this video with 5 people in your life. Not because I'm asking for numbers, because there are people you love who are sitting with the same quiet question you came in with. And they deserve to hear an honest answer too. Subscribe to this channel if you haven't already. We're here every week, not to tell you what to do, but to help you think more clearly about why you do it. That distinction matters more than most people realize. And leave me a comment. Not just a thumbs up, a real one. Tell me where you are right now. What's holding you back? What shifted for you today? What you're finally ready to do? And if you have a topic you want us to tackle next, tell me that too. The best conversations on this channel have always started with something one of you said in the comments. This isn't a broadcast, it's a conversation. And I'm glad you're in it.